During the last stock market crash, investors who chased high-yielding stocks and bonds got crushed. Stop the insanity. Let ETFGuide.com help you. A $100,000 portfolio using our timely strategies should be able to generate between $500 and $2,000 per month. Click on the ready-to-go portfolios at ETFGuide.com to get monthly income trades. We'll show you how to turn your investments into a cash cow. Isn't it time you lowered your risk and increased your monthly income? Go to ETFGuide.com and we'll show you how.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Welcome to the program. Coming up on today's show, a bull market and political chaos. What does it mean for your investment portfolio? Should you be buying, selling, jumping out of your window? We'll talk about that. Also coming up, my program guest will be Salil Mehta. He's a statistician and he's a professor at Georgetown University. We'll be talking about something that goes over your head. I know it does. Tail risk. What does it mean? And how should you build that in and account for that inside your investment portfolio? So Salil Mehta will be my program guest. He'll be joining us a little bit later. And if you'd like to join us to talk about a particular stock, mutual fund, ETF, we're here. 877-711-5611 is the number. Give us your first name along with your city and a ticker symbol. You can also tweet the program live. At Index Show is my Twitter handle, and my email address, ron@indexshow.com. So please join us. We're here again, 877-711-5611. Taking a look at the U.S. government. Lots of political bickering. Really a bull market and political chaos. That's all we've seen. They can't get anything done. And so I feel sorry for those of us that are really looking at making investment decisions based upon what goes on in Washington, D.C., because really you should be focused on your own personal needs, not the needs of the government or what they're going to do or how they're going to decide to do their decisions. And the point here I want to make, ladies and gentlemen, is that focus on your own investment goals. What we are seeing right now is a temporary phenomenon, basically, because, well, we've had this really since 2011, haven't we? Uncertainty with regard to the debt ceiling. And yet, if we would have made a knee-jerk decision in 2011 and sold everything and gone to cash, look at how much you would have missed out. Look at how much you would have missed out in terms of investment returns. So I want to also make the point that we need to understand history. I wrote about this in my October ETF Profit Strategy newsletter, explaining very clearly. Don't listen to these fearmongers who have been spreading the fear, saying that, well, the U.S. government's going to default. Buy gold or go to cash or move into the fields. This is a bunch of nonsense, okay? Because the government will not default when we all expect it. It will happen when you least expect it. And in fact, if you take a look at market history, which we cannot ignore and we certainly can't bet against, since 1960, Congress has acted 79 separate times to permanently raise, temporarily extend, or revise the definition of the debt limit. Okay? This is what they know. This is what they do. They've done it 79 separate times since 1960. And each time, the rhetoric leading up to that gets louder and louder. It was very loud in 2011. It's very loud today, probably louder, but it will get done. It will get done. It will be a piecemeal arrangement, even if it gets extended for a month, as they're talking about. The point here is that the U.S. government will not default based upon history. Now, at some point, there is going to be a reckoning day. I don't deny that at all. But the point here is it won't be self-induced. It won't be self-induced, at least based upon history. And if we take a look at the yield, because the market really has the final say. The market determines who's the winners and who's the losers. And the market right now, there's not a lot of fear. If we take a look at the yield on the 10-year U.S. Treasury, which has come down from poking just above 3%, now at 2.68%. That's the yield on 10-year U.S. Treasuries. And as I told you before, we're going to dance with 3% once again. We're taking a little bit of a breather, and we may see yields dip possibly a little bit more if indeed a debt deal does get done. But the point here is don't make any knee-jerk reactions. Don't make your decisions based upon politics. Focus on the markets. Focus on the trend. Focus on your own investment portfolio, your needs, your financial goals. 877-711-5611 is the number. We're here. We're talking the birds and the bees of successful investing. Please join us. Well, it was a really, really bad week, and we've talked about this so many times. Another bad week for gold. Another bad week for silver. Another bad week for precious metals. And, this is the number one investment theme, and I've listed 10 of them in our Mega Investment Theme Report, which is published every single month in my monthly newsletter at etfguide.com. Number one, is the bull market and political chaos and political idiocy. That's number one. But right up there in the top three is the great gold crash of 2013. And it continued. In fact, if we take a look at the year-to-date performance of the Spider Gold shares, ticker symbol GLD, which tracks the price of gold bullion, it's now down 24% since the beginning of the year. And since peaking on August 22nd of 2011, GLD, which tracks the price of gold bullion, is now down 33.5%. That is the definition of a bear market. And gold bulls and gold bugs are getting slaughtered. On the other hand, it's been a great time to be shorting gold, especially gold mining stocks. And in fact, our latest ETF weekly pick focused exactly on this. Now, we have hit it time and time again on ticker symbol DUST, which aims for triple daily opposite performance to gold miners. We've talked about this, and I gave you a recap on last week's broadcast of our weekly ETF picks, 74%, which have been right since the beginning of the year, 74% winning ratio, which is pretty darn good. You swing the bat and you hit the ball and you get on base 74% of the time, that's an outstanding percentage for winning. And that's what we've averaged since the beginning of the year. Now, our latest one is on ticker symbol DUST, which we recommended to go long last week. We published the weekly picks early Thursday morning, every Thursday morning, early before the market opens. And ticker symbol DUST is the Direction Daily Gold Miner Bear 3X shares. We recommended an entry at around $38.50 a share. And so far, so good. It's popped. It's now around $42 a share. And we'll see if we can sneak out and squeeze some more profits out of this particular trade. And this was one that we jumped into, you'll recall, on September 19th, the day right after the Fed came out with its announcement that it would continue with quantitative easing. And we noticed what happened with the gold miner ETF. The ones that went long, of course, rallied on that news, right? Gold rallied, silver rallied. But we knew that it would be a temporary phenomenon because the bigger term trend is still down in precious metals and gold. And so DUST is our latest pick. We're going to ride this one. And if you want to figure out how to be on the right side of the market and some more details about the trends and the charts on this particular ETF, go to etfguide.com. You're listening to the Index Investing Show. We're here. Coming up in a little bit, we've got Salil Mehta He'll be joining us. He's a professor at Georgetown University. I'll be right back after this short break.
I want you to get together. Put your hands together one time. I want you to get together.
The Index Investing Show with Lon DeLegio.
All right, 877-711-5611. We're here. We're live. We're talking the birds and the bees of successful investing. And based upon history, a debt ceiling will be raised. And we take a look at what Congress has done since 1960. You can shut off the TV. You can shut off all of the media outlets and ignore them because Congress has acted 79 separate times to permanently raise, temporarily extend, or revise the definition of the debt limit. And despite all the political grandstanding and bickering and fighting and chaos, it will get done again. Why do we waste our time doubting? It will get done again. It will be a status quo agreement. And the point here is that a reckoning day will eventually come. But as far as I can see, it's not yet nigh. And the point here is those of us that are also making our investment decisions based upon Washington, D.C. politics, I feel sorry for you. I feel real sorry for you if you're buying and selling based upon what's happening out of D.C. because you're not getting very good signals, are you? In fact, if you would have based your trading decisions or investment decisions based upon what D.C. has done since really 2011, you would have been misguided. You've been misled. You would have missed so many beautiful gains that the stock market has provided. Take a look at the total U.S. stock market since the beginning of the year. Despite all this nonsense, total U.S. stock market ahead by 21% since the beginning of the year. That's ticker symbol VTI. So the stock market, you need to understand, is a leading indicator. Everything else is noise. The market has the final say. And that's what we base our investment decisions on. We don't do it based upon what the House Speaker said or what he's going to say or what he's going to do or what the president says or what the president thinks or what he feels. None of that matters. The stock market is a leading indicator. Base your decisions on that and you won't be misled. And that's what we've been doing. Now, this is quite contrary to how gold bugs and gold investors and people like Peter Schiff and James Turk invest, right? They don't use the trend. They don't use the market as a leading indicator, do they? They use suppositions and biases and personal feelings and what they think about, well, you know, gold is pretty. Gold is going to go up to $5,000 an ounce. Gold's going to go to $10,000 an ounce. Well, really, they're completely wrong. They're completely wrong. They can't see it. They can't see the chart through the trees and the trees through the forest because they're completely blind. And what they are blind guides. And if you listen to that nonsense, well, you'll be led into the pit just like them. And the point here is our latest trade in the weekly ETF picks, and we do one a week at etfguide.com, is ticker symbol DUST, a familiar ticker symbol to ETF Guide subscribers because we've hit it multiple times this year and made multiple profits. And our latest trade involves a long on DUST, which aims for triple daily opposite performance to gold miners. This has been the single best way to capitalize on the great gold collapse, the great silver collapse. And as gold moves down, and I think we'll just have to wait for confirmation, but I think we could very well dance with $1,000 an ounce. And let me tell you, ladies and gentlemen, be ready for that moment because there's going to be some profits on the short side. And the best way to profit thus far and it probably will continue to be, is shorting gold mining stocks, which have been on average historically about twice as volatile as physical bullion itself. So if those historical correlations stay intact, you're going to see some more big upside from shorting gold miners. Ticker symbol DUST. Put it on your radar. And ETFguide.com is the URL. Sign up for my monthly ETF Profit Strategy newsletter. The November edition will be coming out in about a week. Now, which healthcare ETFs, and this has been a great performing sector, a ticker symbol XLV, which tracks healthcare stocks. XLV is the ticker, ahead by 28.5% since the beginning of the year, and easily outperforming the S&P 500, which is ahead by around 20%. So which healthcare ETFs will benefit the most from the Affordable Care Act? Well, thus far, ticker symbol XHS, which is the SPDR S&P Healthcare Services ETF. This is different from XLV, which is the broader S&P healthcare sector ETF. XHS just holds and just focuses on insurers, hospitals, clinics, rehab centers, and nursing homes, all of which are about to get a massive inflow of paying customers from an injection of billions of dollars a year in a variety of new taxes because of this Affordable Health Care Act. And it's far smaller, this particular ETF, compared to XLV. That's the XLV is the healthcare sector SPDR ETF that tracks the broader mix of healthcare stocks within the S&P 500. So, for example, XLV contains some of those pharmaceuticals and biotech stocks, along with the hospital and device makers. But XHS doesn't own any pharmaceutical stocks. It doesn't own any biotechs. It doesn't own those types of companies. It's more narrowly focused. But what's interesting is it's been outperforming the broader healthcare sector by a pretty large margin over the past 2 years. 77% gain for XHS versus just a 12% gain for the broader healthcare sector. So XHS is the ticker symbol, and this particular ETF looks very poised to continue its outperformance and to benefit from the changes that are taking place and happening. And you take a look at some of its largest holdings, higher compensation coming for some of these companies within XHS, like HCA Holdings, Tenet Healthcare Company or Corporation, and then Community Healthcare Systems. All of these stocks up over 180% over the past 2 years. So take a look at that particular ticker symbol, XHS, for those of you that want to play this particular theme, emerging theme of the Affordable Health Care Act. 877-711-5611. That is the number. We're here. Join us if you want to talk about a particular stock, mutual fund, ETF. Do you own gold? Man, you're losing a lot of money if you do. It's dead money is what it really is. And this is pretty much how gold works. It goes through long periods of boom and bust. And we're coming off a very long period of boom. From 2000 to 2012, it had 12 consecutive yearly gains. This will be the first year that gold has lost money in 12 years. And it could be the beginning also of a bust period for gold. And if we look at history, gold, this is how it behaves. It has long periods of boom and of bust. How about rich? Global wealth reached an all-time high of $241 trillion, up almost 5% from last year. That's according to Credit Suisse. U.S. accounted for 72% of the increase of personal wealth. Also, revolving credit, which mostly reflects money owed on credit cards, declined by a seasonally adjusted amount of $883 million. That was in the month of August, according to the Federal Reserve. Other debt, including student loans, rose by $14.5 billion. That's still a big problem. That student loan and outstanding loan that these students have, it's according to latest estimates, just north of $1 trillion. Well, coming up next, we're going to talk about tail risk. What does it mean? How do you hedge for that inside your investment portfolio? Salil Mehta, he's a statistician and a professor at Georgetown University. He's coming up and he joins me next.
Investing Show with Lon DeLegio.
You've heard them on the radio and seen them on TV. Gold experts promising big profits. The truth is, gold prices have crashed, and investment demand is down over 50%, according to the World Gold Council. While gold experts keep promising higher prices, the Profit Strategy newsletter at ETFguide.com told its subscribers the gold bubble would pop. Our gold alert given to subscribers in early 2013 resulted in a 500% gain. Listening to gold experts would have lost you a boatload of money. Listening to ETFguide.com would have helped you to profit. Stop listening to gold experts and stop following the crowd. Subscribe to the Profit Strategy newsletter at etfguide.com and make money. Our no bull approach is world famous, and what happens next in the gold market will shock the entire globe. Join today and get a $50 bonus by using promo code SAVE50. We'll tell you what to buy, what to sell, and when to do it. Be ready for the next big move in gold, only at etfguide.com.
How do you measure financial risk, and how can you incorporate smart risk planning in your own investment portfolio? Here to talk with us about that is Salil Mehta. He's a statistician. He's a former department director at TARP and now an adjunct professor at Georgetown University. Salil, welcome to the Index Investing Show. Great to have you with us.
Likewise, thanks for having me, Ron.
Let's begin about talking and discussing the subject of tail risk. What is tail risk?
Tail risk is having a downward move in an asset price that is greater than what people normally expect and more often than people generally expect.
So would that be like a black swan, or is that not correct?
It's a little bit different. So I think a good example is if investors look to have maybe the S&P 500 in a sort of ETF format or something along those lines. It's a broad market, and they may assume that maybe once a month you might see a downward move in the entire stock index. Once a month, that could be in the magnitude of around 2%. But in reality, you might have once a month a downward move of more like 3%, or at the 2% level, maybe that would happen twice a month instead of once a month. So that's really what tail risk is. It's more systematic, and black swan events are a little bit different in the sense that they're exogenous. They come out of left field. For example, a 9/11 attack, or something that might happen in Syria that can kind of change things. Very exogenous to what's really kind of inside, the way people should think about their assets, general performance risk.
Now, what about tail risk, Salil, as it applies to, let's say, other asset classes and the performance impact there? You just kind of gave us a heads up on stocks. Give us a heads up on tail risk and how it impacts other assets.
Sure. Tail risk applies to all asset classes in the financial markets. We've seen tail risk, for example, show up recently in treasury markets, where people generally thought that this is really a risk-free asset class, values that generally go up and almost never come down. People thought the same thing about the real estate market through 2007. And so we see this in different asset classes, and really the only asset class, barring huge financial shock, would be having some money in cash. But all of these financial instruments, they do tend to have some tail risk in there. And in addition, the economic data that we look at, in which we then try to value what asset values should look like, that too has some tail risk. And we see that in massive revisions to GDP data or unemployment data, things like that.
If you're just joining us, you're listening to the Index Investing Show. Pleased to be talking with Salil Mehta. He's a statistician, financial scientist. He's also an adjunct professor at Georgetown University. He's also working on a book about statistics and numbers. Now, what about current events? How does tail risk impact them?
Sure. So in terms of current events, if people are looking at, well, what's happening with the current debt battles happening in Congress or what's happening with tapering, those would generally not be something that impacts tail risk. Tail risk is really embedded in long historical data sets of financial instruments, be it bonds, stocks of other nations and things like that. So what we're seeing right now play out wouldn't really impact whether, or even explain whether or not we have more or less tail risk. Tail risk seems to be present regardless of the sorts of geopolitical concerns.
So, thinking about what you just said about tail risk, Salil, and how some investors and traders look and extract historical data, I think about those that trade upon seasonal patterns. Kind of risky after what you just mentioned, tail risk. I mean, tail risk at any given moment can render completely worthless all of those trades and research based upon seasonal or historical seasonal patterns. What do you think about that?
You're definitely right, Ron. There's definitely cross currents when it comes to this sort of analysis. When you talk about seasonal patterns, so it could be days of the week or months of the year, there tends to be seasonal patterns that show, for example, higher degrees of risk in equity markets in October, November time. But that doesn't mean that every October, November, people should be frightened of the market. So there is times where you need to incorporate multiple factors, not just one, like seasonality, something like that. And certainly, people should look at multiple inputs into their analysis. So look at multiple risk measures and look at multiple sets of economic or fundamental data, not just look at what is just in vogue in the current news.
So we know that tail risk can cause assets to sometimes trade outside of their historical price range. So let's break this down from an investment perspective and the individual investor. How should an investor design their investment portfolios with tail risk in mind?
Sure. So one thing to keep in mind is that they should demand and look at multiple, measures of risk in whatever asset that they're trying to invest in. So instead of just looking at what's the expected return that they might get and get excited about that, look at some of the ways in which the asset class could experience losses. And in that sense, they would probably come up with something that would have a couple different outcomes. The first is that things that have been considered more risk-free, like bonds, treasuries, would generally have more risk than they might anticipate. Not as much as equity still, but still higher than risk-free, literally. And then the second is they might want to keep a higher level of cash in their portfolios to take advantage of these extreme moves in the market, which inevitably occur, and they'll be better off having some cash on hand to take advantage of those opportunities.
Isn't that great advice? I mean, cash is, to me, like the Rodney Dangerfield of asset classes. I mean, it gets absolutely no respect, and that's a really, really good point. If you're just joining us, we're pleased to be talking with Salil Mehta. He's an adjunct professor at Georgetown University. He's a statistician. He's a financial scientist, and he's an author. He's got an upcoming book. One final thing before you take off. How important is tail risk versus other types of risks that investors usually consider and try to plan around?
Sure. It depends on where we are in any sort of volatility regime or where we are in the investment climate. So right now, I would say that investors have been very complacent. They've gone through multiple years of having very low volatility, much lower than normal. And this is something where usually normal measures of volatility like standard deviation would be fine. But especially now when people have been lulled into a false sense of security, they might want to anticipate that a year from now, we can have a lot more tail risk, and those sorts of asset classes should be considered more risky than you might normally want to take into account tail risk measures. So we'll definitely revert to the mean, and it won't be, it should be something people should be more cautious of.
Absolutely. Instead of shorting volatility, maybe go long volatility. And especially, you mentioned there, volatility being low, we see the VIX definitely trading near the, I know at least over the past decade, near its 10-year average low or historical range. Well, that was a great interview. And just before you leave, tell us a little bit about your upcoming book. I know you're working on a book about statistics. Tell us more.
Sure. Yeah, sure, Ron. I'm working on a book that discusses topics of statistics. It goes through the basic types of statistics you would learn in current college curriculum, and it applies that to a variety of settings in economics.
Well, we're looking forward to it, and I hope to have you back. We can talk a little bit more about that. Again, you just heard from Salil Mehta, adjunct professor at Georgetown University and statistician and financial scientist. This is the Index Investing Show. I'm Ron DeLegge. More when we return. Go nowhere.
The Index Investing Show with Ron DeLegge.
So, what if you made the knee-jerk reaction and decision during the 2011 debt ceiling debate when the U.S. government had its credit rating downgraded by Standard & Poor's? What if you made the decision because of the political volatility, because of the political nonsense and chaos, you made the decision that, I'm going to go to cash. I'm going to sell out all my stocks and get rid of that because, well, I don't like what I see happening in Washington, D.C. How would it have turned out for you? Well, since August of 2011 through the market close of October 11, 2013, you would have missed out on 32%. A 32% return since 2011. That's how much gains you would have missed out on had you made that knee-jerk reaction. So I'm illustrating this. I'm not telling you to keep all your money in stocks. That's not my point. My point is don't make your investment decisions. Don't let your investment decisions be driven by politics or what's happening in Washington, D.C. That's a nonsensical way to invest. Really, we don't make our decisions that way. We look at, in terms of our core portfolio, and all of us should have a core portfolio. In other words, a foundation of low-cost index funds and index ETFs linked to major market indexes. That's the core. That's the foundation of your portfolio. So we're talking all major asset classes in that core. And ETFs tracking those asset classes. Stocks is just one asset class. You've got other asset classes like commodities and real estate and cash and bonds and tips. And this is how you build what's called a diversified portfolio. So that's your core. And then your non-core, or core enhanced, as some call it in portfolio school on Wall Street, your non-core can consist of, well, other things. For example, if you want to make strategic moves or trades, kind of like we've been doing at ETFguide.com, if you want to buy an inverse leveraged ETF that aims for triple magnification or triple daily opposite performance, well, that's what we would call our non-core part of our portfolio. We can do that after the core has been built, or if we want to invest in IPOs or individual stocks or crowdfunding or whatever else. That's all your non-core part of your investment portfolio. So this is how you build a logical investment arrangement so that you can reach your financial goals. That's what we're really trying to help you do. And the only way you can do that is by clearly organizing your investment portfolio, segregating it into various asset classes. But the key here is by having a core and a non-core portion of your portfolio. I think it will help you to better organize and also to better achieve what you're after in limiting your risk and reaching your financial goals. 877-711-5611 is the number. We're here. If you ever miss our daily, or rather our weekly broadcast, you can pick up our podcast, which is basically an archive of our regular radio broadcast. It's available at iTunes. We also publish it at YouTube, so you can just search under the Index Investing Show. If you'd like to join us, we're here, 877-711-5611. You can also tweet the program live and follow us at Index Show, and my email address, ron@indexshow.com. So coming off a nice interview there with Salil Mehta, a statistician and professor at Georgetown University. We will also have him back on the show. That was his first time on our program, and I thought he did a fantastic job. We talked about tail risk and what that means. Basically, an unexpected move or price movement of an asset price, whether that's stocks, bonds, gold, whatever, outside of its historical trading range. What I learned from that interview, too, is that tail risk is already embedded in long-term prices. It's not something that's impacted by geopolitical concerns or short-term gyrations caused by various things like politics or perhaps a rogue wave or black swan. How that can impact financial markets, that's not tail risk. So tail risk is also something that affects all market prices. But the other thing, too, that I really appreciated from that interview is it confirmed in my mind, this is one of the reasons why we don't make investment decisions or base things upon seasonal trades. I know that there's a lot of seasonal traders out there that base their decisions on, well, it's time to be long heating oil because it's winter and there's more demand for heating oil during winter, so that's a seasonal trade. Let's go long heating oil, or let's go short gold in its worst historical period, which generally tends to be during the late spring and early summer months. Not generally a good time to be a long precious metals if you base that upon seasonal patterns. But the problem there is that tail risk can totally blindside the seasonal trader and seasonal trade, as it has often done. This is why, if you're going to trade, it's better to do it based upon prices. Trade prices. Don't trade seasons. And this is one of the reasons why we've been able to make multiple moves, because we don't trade seasons. When we talk about the non-core portion of the portfolio and strategic moves or strategic trades, you got to absolutely look at what the heck is going on with prices. What's going on right now? What is the trend saying? And we've taken a look at this and discussed it many times. The biggest investment theme of 2013, the Great Gold Crash. And we continue to see gold, silver, precious metals, gold miners continue to perform horribly. And it's a great, great opportunity for you bears. And I know that you bears have been waiting for the bigger theme of the stock market, global stock markets, to fall. Well, why are you going to suffer? Why are you going to try to short markets that are clearly in an uptrend? Better to focus your efforts, better to focus your attention on already weak markets. Those are the ones you should be shorting and making money on as you wait for the other bigger theme of the fall in global stock market prices, which has not yet happened. So that's the way you should be doing it in terms of strategic moves. It's like we've done at etfguide.com. And our latest one I told you is ticker symbol DUST. We added that particular ETF as a buy last week. We're already up nicely. It's settled in on the low 40s. We'll see if that particular fund can add some more gains. It will if precious metal prices continue to fall and gold mining stocks continue to fall as they have. 877-711-5611 is the number. Now, taking a look at the global financial markets, we already told you about U.S. stocks already ahead year to date by 21%. International stocks from countries like Japan and the United Kingdom and Canada and Australia. VEA follows stocks from all of those countries, ahead by just over 13%. Emerging market stocks continue to lag, but have nevertheless added to their some gains over the past several months. But VWO, since the beginning of the year, which tracks emerging market stocks, down around 5.5%. Total U.S. bond market still not doing well, down 4%. And the basic reason there, interest rates, when they rise, bond yields when they rise, means lower bond prices, and that's what we've had. Gold, ticker symbol GLD, down 24% since the beginning of the year. Well, you know my opinion on that one. Ticker symbol VNQ follows real estate stocks, or REITs, in the U.S., ahead by just a nudge over 3%. And we already told you about some of the top-performing sectors within the S&P 500. Healthcare stocks, XLV, ahead by 28.5%. That sector outperforming the broader S&P 500, along with consumer discretionary stocks, XLY, ahead by just a nudge over 28%. So those two sectors are leading the S&P 500 higher. And you've got all 9 industry sectors within the S&P 500 in positive territory. What does that tell you about the strength of this particular stock market rally? And all of them, too, by the way, with the exception of utility stocks, in double-digit territory. Well, that does it for another episode of the Index Investing Show. Join us again next week. Same time, same station. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.